Good morning, everyone, and welcome to today's webinar. My name is Alex Paul from InvestorStream, and I'll be your host today. Presenting for you today is AXP Energy Managing Director Tim Hart and Non-Executive Director Sam Jarvis to discuss the company's recent quarterly activities and other near-term value catalysts. Sam and Tim will give a short presentation on this progress, and we'll be on hand to address any questions following the presentation. Please feel free to send in your questions via the chat platform in the question pane in the GoToWebinar control panel, or simply email them to me at alex@investorstream.com.au. Many of you also already taking the opportunity to send them through via that platform. It's greatly appreciated. We'll try to get through as many questions as we can, but it's obviously mindful that we only have a short period of time to get through them. You can also download a copy of the presentation by navigating to the handouts pane in the GoToWebinar control panel. A copy of the webinar will also be on AXP's website and social media platforms later today. But for now, I'm going to throw things over to Sam to kick things off. Sam, the floor is yours.
Thanks, Alex, and thanks to everybody who's joined today. I'd like to begin by quickly running through the quarterly numbers. We had quarterly net revenue of 4.9 million, which was up over 8% on the prior quarter. Customer receipts were down 5% to 4.4 million, but this is just a timing issue with respect to actual incoming payments. Gross production was down 6% on the last quarter, and you can see from the chart in front of you that this is related to gas production and therefore sales, which were held back by continued outages and issues that we've had with our downstream processing partner, and Tim is going to talk more about that, what we're doing to resolve these bottlenecks. Finally, we had just over $500,000 once-off costs, which is a lot less than the almost $1 million in once-offs than we had last quarter. So two takeaways from the end of the quarter and looking forward. Firstly, we've got a strong cash position and we're very well funded in terms of carrying out field development and production improvements that are in progress or planned in the short and medium term. And we're now aggressively selling down our oil inventory, which Tim will show the progress on also later. So that cash position is building further still. Secondly, and just to round out the quarter and look forward, we've spent the last 4 quarters basically integrating 4 businesses and a large and complex suite of assets. And this has inevitably come with its challenges, but now really having our arms around these assets, we're realizing the upside. We're seeing the upside, we're realizing it, and we want to deliver on it. So we are of the very firm belief that we're well positioned for a meaningful turnaround in this and the coming quarters. And with that, I'll hand over to Tim to talk through what we're doing operationally to actually realize this turnaround.
Thank you, Sam. And thank you, Alex. It's great to be back on InvestorStream. And first, let me thank you all for attending today. One of the criticisms that we probably deserve is our sparse communications over the last few quarters, and I know this discussion is well overdue. In this instance, we've had a few challenging back-to-back quarters. We were able to grow top-line sales, but expenses and margins were not what we were managing to. And that was partly expected due to the fact that weather in this part of North America impacts operations, and these are typically lower production quarters. However, the challenges were significantly greater due to the downstream issues, and those, at least to the degree that we had experienced them, were not expected. So as we were moving through these 2 quarters, my primary focus has been on how to navigate through the downstream issue, but yet still come out ahead. And we'll talk more about that as we move through the presentation. We were adjusting along the way to react to the economic impact of the lack of reliability in our primary sales channel. And the majority of our operational focus was on the enhancement of wells inside this sales channel. And we weren't able to demonstrate those wins because we couldn't get the gas to market. And so we were presented with a pretty big problem on the outset of merging 4 different companies together, with the Appalachian basin assets being our primary focus. And so that's where we've been. and we've developed what we believe to be a winning strategy, and that's what we're here to present. So I'd like to turn your attention to slide 4 on the screen. We've previously flagged that midstream sales channel as impacting sales, and you'll see through the presentation here that the theme of the maps is that the presentation maps are color-coded to differentiate wells that sell into that sales channel. The orange wells being the area of mutual interest outlined by the red dotted line, and the fields are shaded in orange. Those wells are all selling into that sales channel, and the fields that are outlined in green are wells that are selling into highly reliable alternate sales channels. So, and this map sort of depicts in the Appalachian basin the portion of the wells that sell into and the portion of the wells that don't sell into that sales channel. So, Alex, slide 5, please. So carrying on with our color scheme, the wells in the orange box at the top are wells that produce into that midstream provider. We'll call them off-taker A. And as you can see, there's 833 wells, and currently that sales channel moves about 74% of our gross gas production. However, we have 309 other wells listed in the green table that sell into 6 completely different sales channels. And these sales channels, we're calling off-takers B through G, are all long-term and mature contracts. They have a long history of reliability. And most importantly, they can take a lot more gas, probably more than we can produce. And one of the things that I want to talk with you about is the significance of these 309 wells. The majority of these wells have not been touched since 2007, other than the work that we had done in the KJ field last year. And what I mean by that is there's been no swabbing, no workovers, no significant maintenance. So there's really a lot of runway for improvement, and that's become our primary focus temporarily as we continue to work through work with our midstream partners. And this is also where the KJ field's located. And for those of you who have been following us for a bit, back in July we started repairing a pipeline in the KJ field, and in a few months' time we added another 500,000 cubic feet to our production. And so this is the type of success that can be realized with these wells. And the production from these wells currently represents approximately 22% of the gas production. And with the focus being redirected here, these wells have the capacity to produce a lot more. So while we're working through improving the reliability of off-taker A, we'll be developing primarily within the fields in the green box. Can you please advance to slide 6, Alex? So this slide shows our Illinois Basin leases, again, color-coded in green, and these are broken out by field, and the image represents the consolidated acreage from 3 different acquisitions into AXP Energy, Inc. We acquired Kentucky Exploration, the other 50% of the JV of Kentucky Exploration, in November of 2021. Trey Exploration acquisition was finalized in October of 2021, and MHP acquisition was finalized in March of 2021. So it was a busy year. But also shown in this image are the 2 wells that were recently fracked in the Drakesboro field, the DPI 2604 and the DPI 2605. So that's where those 2 wells are located. Next slide, please, Alex. So there's 243 wells in the Illinois Basin that currently move about a quarter of our oil production and 4% of our gas production. There's tremendous opportunities for exploration and development in the Illinois Basin acreage. And again, we've been in a mode where we've not been actively developing through these last 2 quarters. So minimal development work that we have done here are the 2 DUCs, and we'll talk more about those in the next series of slides. And that said, I believe we have some of the best acreage in the Illinois Basin, and I'm anxious to prioritize this development in the coming quarters. Next slide, please, Alex. So you've heard us talk about inventory sell down quite a bit. And to give you a little bit of color on this, prior to us acquiring MHP, there were some difficulties selling inventory in the Appalachian Basin for several reasons. The first and foremost is the terrain is very difficult. We have 336 tank batteries that are strewn across the Appalachian Mountains, and we use smaller vac trucks to collect the oil in these tanks. And then we move that inventory to one of 9 different load zones. And these load zones are accessible by tanker truck, and the oil is shipped from these load zones to the refinery for sale. And historically, a third-party oil purchaser was used to move the oil from the load zones to the refinery. Issue is, since our acreage is further from the refinery than the other producers in the area, the third-party purchasers were de-incentivized to move our oil due to the fact that they could make more money by moving closer shipments faster. So we solved this problem by bringing this function in-house. We bought 3 semi-trucks, 2 tankers, and an additional vac truck to give us a total of 3 vac trucks that we run in the Appalachian Basin. We hired several drivers, and now we're able to not only keep up with the production, but also we've been busy selling down the inventory to just over 15,000 barrels. As you can see, at Q4 of 2021, we were at just north of 22,000 barrels, and now we're sitting at just north of 15,000 barrels. So that problem has been solved. Slide 9, please. So this slide's a fairly busy one. From an operational standpoint, we have a number of priorities that we're focused on, and a very, very high priority for us is that we continue to work with our midstream provider. We have weekly meetings with their senior management and operations teams to discuss the performance. We've had established additional performance metrics and communication protocols to manage to, and they continue to implement additional changes to the system to improve the reliability. And the majority of the outages through the last 2 quarters were related to pipeline issues due to fluctuating temperatures. And so we've seen some near-term improvements that we're encouraged by, aided in part by the warmer months. And so I do want to point out that this continues to be a very important sales channel for us, and we'll continue to work very hard to influence its performance in a positive way. And it appears to be moving in the right direction, which I'm very happy to report. However, as discussed in the previous slides, we've temporarily shifted our development focus to areas outside of the sales channel, and we'll continue to do so until the issues have been completely resolved. Our primary focus in the near term will be on the 300+ wells in the Appalachian Basin. But as I mentioned, we've got a tremendous opportunity when the time is right to work in the Illinois Basin, 240+ wells that we have there. And just to give you a little context on the types of opportunities we have with these 300+ wells in the Appalachian Basin, our team has been very busy analyzing these wells outside of that AMI. And we found a large number of wells that were drilled and produced using an open hole completion. And the wells produced for a short while, and then the wellbores caved in due to lack of casing support because they were completed without casing. This occurred more frequently in the larger wells. As the more intense the gas flow, the more unstable the wellbore became. And a number of these wells IP'd at rates between 3 million and 6 million cubic feet per day. These wells need to be cleaned out, cased, and put back into production. And we're talking about some a potential for some very, very significant uplifts in production with these opportunities. There's also a large number of wells that have been cased and were completed in the primary zone at the time when they were drilled. But since that time, there have been additional producing formations discovered that these wells traverse through. And so all that's required is to perforate and complete these zones. And there are several nearby operators that are having tremendous success with this. And the majority of the wells in the green section of the map haven't been swabbed since 2007. And for those who are curious, when you have a gas well that produces fluid, the gas well production is reduced as the fluid builds up in the wellbore. And once the column of fluid gets high enough, the well can stop producing altogether. And as soon as the fluid's evacuated or swabbed, the production returns. And so we have a swab rig and a crew running full time, but the focus has been on the wells in the area inside of the AMI. And so now they've been temporarily redirected to the other fields to bring on additional production in those other fields in green. The opportunities for additional production within this asset are enormous, and you'll start to see this being realized as we develop those areas in green. We have the 2 ducts that were fracked in February, and by a show of hands, how many of you have given up on those ducts? I was just kidding, I can't see you, but my guess is that there were a lot of hands in the air. A couple of things I want you to know about those 2 ducts. One is they were completed in a fairly new formation in the Illinois Basin called the Salem-Warsaw. And operationally, we were in new territory. Not only are these assets new to us, but we were exploring in a formation that was fairly new to everybody in the area. And this production in the Salem-Warsaw is present, but it's an emerging formation, so there's a lot of unknowns. And we had some operational challenges on the DPI 2605, which have been overcome, and we'll be reporting on them soon. And the last thing I want to tell you about those is that, I will tell you that I'm encouraged by what I'm seeing, and in a few weeks, you can determine for yourself. The Elite mining site in Colorado is back on track. This project certainly has had its challenges with the regulatory and permitting delays, and the difficulty in getting the generators to the site due to deficiencies in the logistics and supply chain here in the US and in other parts of the world as a result of COVID. We also had a vandalism event that occurred, which added some additional significant delays. But I am happy to report that perseverance has prevailed, and we're breaking ground for the new cooling systems to be installed later this week. And we anticipate the system will be online in late June. From a corporate standpoint, we've had to consolidate 4 different companies into one financial system, and the system that we had in place at the time of the acquisition wasn't adequate to handle it. And furthermore, we've built out our human resources to support that effort, and I'd like to thank both Brad Mervis and Stephen Lampner for all of their efforts in getting our financial systems tuned up to support our growing business. I think those guys have done a phenomenal job moving that forward. And that transition is nearing completion, and once completed, our company will be well positioned to support additional growth. And you may have seen the announcement last week about our new pricing contracts. It's a bit of a crazy world out there right now with the fluctuations in the oil and gas price environment. In March, 47 days ago, the average price of gas was $4.90. And just last month, it was $6.60. And now we're seeing spikes above $8. And we're always evaluating how to best position ourselves with our gas contracts. And just so you know, my philosophy has been to protect the downside in the summer and the upside in the winter. And we'll continue to deploy this strategy as we move forward. We've contracted a larger volume through the summer where prices are typically softer, and we've left some room in the winter months to take advantage of stronger pricing. And we've locked in some very favorable terms over the next year, but also left some room for uncommitted volumes to take advantage of the swings that we're seeing today. And suffice it to say that the macro environment in the oil and gas sector at the moment is very favorable, and this is very good for all of us. That said, I've been around long enough to know that this business fluctuates, and we'll always work hard to take full advantage of the upswings, but structure ourselves to be healthy during the downtimes. Margins matter always. Slide 10, please. So this is the definition of our value proposition, and I know you've probably all seen this previously, and so I won't talk through it. You'll probably see it again as we continue to communicate with you. So that concludes the slide deck presentation, but I'd like to take a moment to thank a few people. RD Hamilton is our Vice President of Operations, and RD has been working tirelessly to help us integrate all of the different businesses into the AXP Inc. operations, methodology, and strategy. And things are going very well in that regard. And he's been faced with some challenging circumstances associated with the difficult sales channel as well. I'd also like to take a moment to thank the AXP Board of Directors for their support and guidance. We've just come through a fairly difficult time with these last 2 quarters, and they're asking the right questions and applying the right logic to arrive at good outcomes for the shareholders while still supporting the team, and I'm grateful for it. And in addition to that, I'd also like to thank the AXP shareholders for their continued confidence in us. I recognize that the share price has fluctuated as we've been moving through these last few quarters, but that is not representative of the future value of the company, and we look forward to demonstrating that as we continue to move forward. And we wanted to get this last quarter out of the way, and we're anxious to provide more updates as things progress. And with that, I'll turn it back over to you, Alex.
Thanks, Tim. We have been inundated with questions over the course of the presentation. So I'd like to address the first question to Sam, if I can. Sam, last webinar 3 months ago, a lack of communications with shareholders was admitted, and shareholders were promised more communication, and it never materialised. Is there a reason for that?
Thanks, Alex. Well, the last quarter didn't see us translate top-line growth to the bottom line. Traditionally, it's a tough quarter due to winter, but we were really hurt by the outages, which compounded the, I guess, inherent weather-related difficulties that we have during that period. So for the board and the management team, the most prudent thing to do was not go and spruik operational progress, knowing that we were going to deliver, a quarterly result that we were not satisfied with as a board, and nor was Tim or management. And the board is very mindful of this. So, going forward, we want to announce what we have achieved and what we are in the process of achieving, and not what we hope to achieve. And, with a framework and with a focus on margins and delivering value. And having said that, we are encouraged by what we're seeing emerging across our operations, and we expect to deliver more regular and more meaningful share updates in the near term.
Thanks, Sam. Now, turning to you, Tim, can you just expand a bit on the rationale behind contracting a significant proportion of your gas volume at $5.84 when spot prices are around the $8 mark?
Sure, Alex. I just wanted to make one comment on the last question as well. Given the challenge in communications over the last couple of quarters, we've had a lot of thoughts regarding whether or not we should be communicating via Twitter, and so we are discussing this, but we've largely decided that our communications really needs to be governed by our ASX releases, to ensure that we aren't violating or even straddling a line, violating our continuous disclosures that are required. And we have adopted a position where we believe that this is the best way forward. And so our intent is to increase the amount of ASX releases, and then we'll talk to those releases in our communications with the market, and that's the approach that we have chosen at the moment. And I wanted to share that, as I know there have been lots of our shareholders and folks that have a desire to hear from us on Twitter. We're a bit silent, and that's the reason why. So. With that said, as I mentioned in my comments while talking through the slide deck, the market fluctuations are relatively recent, with the average market price, as I mentioned, 47 days ago at $4.90. So, while I'm watching the gas prices go up to $8, it's an emotional roller coaster for me too, like everyone else, because you wonder what's around the next corner. However, they are fluctuations and they are very, very new. And what we have done really is protected ourselves through the time of year when it's really risky. And so in addition to this, I think it's noteworthy that we were in a long-term contract for $3.81 a decatherm, which we had to buy out or roll forward in order to leverage the current uplift in pricing. But I do want to point out that we have many different sales points and contracts that we sell gas through at different pricing points, and a significant portion of the gas that we sell is sold based on an index variance, which fluctuates with the market. And this is very good right now, but typically a bit risky through the warmer months. And as I mentioned, I'll always deploy a philosophy of protecting our downside through the summer and upside through the winter. And I see that that new contract as an insurance policy, but we've also left room for us to take advantage of the stronger pricing with the uncommitted volumes.
Thanks, Tim. I'll turn back to you, Sam. When can we anticipate an uplift in the share price when you take into consideration the company's future forecasts?
Thanks, Alex. Good question. As I said at the beginning of the call, we've now well and truly got our arms around the businesses, and the shareholders should rightfully expect that we not only deliver on the top line, but that this translates to the bottom line with improved margins or through improved margins. We are confident that this is now happening. So a true or meaningful yardstick is really what you'll see in the next quarterly, and this should be an appropriate catalyst. But I think probably the other measure that our investor base look very carefully at in anticipation is demonstrating the value that we have locked up in our assets and in the leases that we have. Our R&R report partially reflects this, but so too is demonstrating that some of the wells that we have can deliver big production gains, not just the small incremental growth that we're focused on to date with the workover plan and the development plan. We see a lot of significant targets in our leases, as Tim's touched on, and we're going to share some of these opportunities with shareholders in the near future, in the coming months.
Thanks, Sam. Now, Tim, you mentioned midstream or / distribution issues multiple quarters now, and most recently you said it affects 75% of your natural gas production. Can you elaborate on the types of failures you're seeing, and how confident are you that there'll be meaningful improvement in the next couple of months?
So most of the outages that occurred through the last 2 quarters were pipeline issues and related to temperature fluctuations. And basically there was excess fluid in the line that froze. And this particular issue is being solved by putting a booster in the middle of the field to increase the velocity of the gas in order to pull any fluid along prior to it freezing. And the booster is currently on site awaiting approval on the permit. So that improvement, which we believe will have a profound impact on not only the reliability of the system, but should also pull the pressures down in the field that allows our production to be elevated as well. And in addition to this, there have been procedures that have been implemented to ensure maximum efficiency of the dehy units, which are sitting at the edge of the fields that pull liquids out of the gas stream prior to it entering the pipeline. So, the 2 most significant issues that we saw through the last 2 quarters, I have a very high degree of confidence that those issues are on their way to resolution with everything that has been done over the last several months.
Thanks, Tim. Now, Sam, would you ever consider dividends going forward rather than any massive reverse splits or buybacks? I think the investors foresee a lot of cash coming in over the next year or two. And is that an option that you're considering?
Well, that's truly our primary vision. I mean, about 12 months ago when we acquired MHP, we said that our benchmark was to replicate what AIM-listed Diversified Energy Group does. And it's exactly that. Diversified is a strong cash-generating business that pays regular dividends. And we have the foundation of that here today, and that's where we want to head. Tim and I firmly share this vision because we and our families are significant shareholders, and we're very aligned on that. But our first priority is just to build the cash base and move into more significant field development. The company's not raised equity since 2020, and as we've said, we're building a nice cash cushion, and this is worth bearing in mind. But yes, that is the vision, absolutely.
Thanks, Tim. Now, Sam, Tim, back to you. Any discussions with other companies looking to purchase stranded natural gas?
Yes, we've had multiple discussions with various companies about stranded gas, and I must say that with the price of gas where it is today, we're working double time to ensure that any stranded gas that did exist finds a home in a pipeline. The economic justification for that is a lot more significant today than it was a year ago, and quite frankly, even 6 months ago or 3 months ago. The current economics of gas being used for power generation are not nearly as favorable as they were just a few months ago as a result of the gas pricing. So we're working to get the Colorado site up, and once this site's operational, we'll be exploring additional possibilities of adding additional sites where gas is truly stranded and unable to reach a pipeline.
And so, Tim, are you starting, or are you in the midst of any discussions with oil prospectors or producers to team in on larger oil plays?
So we're always looking for opportunities and currently expanding our lease position in areas that we're currently operating. But having said that, we've really got a huge untapped opportunity in our existing leases. The legacy Trey acreage that we got with the North Hanson old Exxon field that exists in Western Kentucky. I mean, we haven't even done anything with that yet. And there are examples of that everywhere you look in the acreage position that we have put together right now. And so these are certainly our first priorities. And the other thing is that we don't really want to raise equity at these levels to pursue any new opportunities. So we will continue to develop what we have and demonstrate that value to the market, and then we'll look beyond.
So I guess further to that then, Tim, are there any discussions ongoing with other entities regarding oil or gas export contracts?
The demand for oil and gas right here in the U.S. Is very, very high, and so quite frankly, we really haven't seriously considered any export contracts because we have a home for it right here.
Thanks, Tim. Now, back to you, Sam, if I can. The share price plunged more than 50% since the last webinar. Overall, how do you see the company going in terms of listing on the OTC?
Thanks, Alex. Well, I think I've addressed the share price. I mean, we have seen a lot of volatility in the last the last few months. I think in terms of the OTC, we are continuing with that, but we need to improve things from the ground and show what we're doing, and the share price will reflect that.
So I guess further to that then, Sam, are there any plans for reducing the 6 billion share count?
Not in the immediate term, but it is something we are mindful of, and it is something we consider perhaps in the medium term.
Thanks, Sam. Now, back to you, Tim, if I can. The old saying, of course, oils ain't oils. What's the quality of oil produced by AXP? Is it waxy, heavy, light? What's its API rating, and what discount to the published daily price do they receive for oil sold?
Gosh, well, in Eastern Kentucky, the API is around 41. And we get paid what they call the Kentucky posted price, which is in line with WTI. And it's a bit different in the Illinois Basin over in Western Kentucky. With that oil in the range of 35 to 39, and it's priced on based on the Plains WTI, which is a slight discount to WTI. I think it's $4, a $4 discount to WTI.
So, Tim, what specific steps does AXP intend on taking to ensure maximum marketable gas flows in the region that are affected by midstream outage issues?
So I'm just going to kind of reiterate the things that we're doing, and quite simply, we continue working with the midstream provider, and let me just state that this situation with the midstream provider is a temporary situation, and it will be resolved with the steps that are currently being taken. The best thing about this situation is that the midstream provider and AXP are aligned in what they want the outcome to be. It does not benefit either party to have outages, and consequently, we are working very, very closely with them to improve that situation. And there is absolutely no question in my mind that we are moving in the right direction with that, and that this will be something that we all think about that happened in the past, in the very near future. That said, in the meantime, we did some development inside the AMI over the last, I don't know, since we've had the asset, and we weren't really able to demonstrate meaningful results with that, with those additional operational efforts inside the AMI as a result of these outages, and so that's not good. So in the meantime, we're moving our operational focus outside of that AMI and developing in those green areas that were represented on the maps. And let me point out again that those sales channels are very reliable sales channels, and they're very attractive sales channels. And quite frankly, I think that there's an argument to be made that the volumes in the green area have not had nearly as much attention as the volumes in the red area or the orange area of the map. So I really have high expectations of what we can do with those wells that have been a bit underloved outside of that AMI.
So, Tim, you mentioned the sales channels there. Can you just give us a flavour of what work is ongoing in this new sales channel?
Sure. So, as I mentioned in the webinar, I'll just give you an example in the KJ field. Again, the KJ field had some significant mining operations that have occurred, and when those mining operations occurred in distant past, the gathering system had to be taken up and made way for the mining operation. And last year in July, we added we added about, I think it was 22,000 feet, maybe 5 miles of pipeline. And we put 30 some odd wells back online, and we're able to increase the production by, like I said, 500,000 cubic feet. Well, there are other projects that are very, very similar to that in the KJ field. And because we've had success in that field, in short order, I'm going to focus primarily on the KJ field. I think there are 200 and some odd wells in that field. I don't have the number in front of me, but the majority of those wells, other than the 30 some odd wells that we put online, have not been really touched. And so the very first thing that we're doing is we're swabbing those wells to pull the water off of them to see how much we can increase production with a simple swabbing exercise. In addition to that, we have identified a number of additional wells in that field where the pipeline is still broken, and so we've got our pipeline guys out there in the field right now, fixing pipelines and bringing additional wells online. And there are a number of wells inside of that field that also were produced open hole, and I made reference to those open hole completions and the potential associated with those as I was talking through the webinar. So, I mean, it's almost like everywhere we look, every rock we turn over, we find something that is remarkable and profound. With the soft couple of quarters that we've had, my intent for this quarter is to only do work that is going to pay back within this quarter, and that is so that we can, gain the trust of the market, show the cash build, show the quality of the asset, and then we'll take some bigger swings as we move down the track. So, but they're absolutely there to take, and those are the kinds of things that we're doing.
And just finally, Tim, you're saying that this quarter is going to be better. I can see you're finally selling down oil more aggressively. Is this what will drive improved performance, in your opinion?
Well, we're seeing some improvements in this quarter for a couple of reasons. One is the weather is very helpful, so we don't have the inherent challenges associated with the difficulty in production as a result of the weather. I think the work that we're doing with the midstream provider is paying some dividends for us. It's funny, Alex, when you go through something like that, and you're challenged with your predictions not coming true, it makes you really look at things with a different light. And as we shifted our operational focus outside of that AMI, some of the things that we found are pretty daggone exciting. And so, and some of them are very, very low cost, like swabbing, just pulling water off the wells. And so it's those efforts that the team has come up with to get some wins relatively early in the process that are relatively cheap and don't take a whole lot of time to do. And I think it's a culmination of all of those things that are going to see us through to a much better quarter than we've seen in the past two.
Fantastic, Tim. Well, that's all the time we have today. Thank you all for joining me, and I'll also like to thank both Sam and Tim for presenting and taking the time to answer some questions. Thank you all for the high level of questions. We were inundated with questions today, and apologies we didn't manage to get to yours, but it shows a high level of engagement among the AXP shareholders. As I mentioned before, a recording of the webinar will be on AXP's website and social media platforms later today. Tim, before I let you go, do you have any final comments to leave with us today?
I again just want to thank the shareholders for their patience, and we've got a really strong shareholder group, some of which are very, very long term, and it is absolutely my intent to work as hard as I possibly can to demonstrate the maximum value of this asset that we've built. I have a tremendous amount of confidence in it. And I look forward to the next series of quarters so that we can show that to the world.
Fantastic. Well, that wraps it up for us here. Thank you, everyone. Have a great day, and we'll chat to you soon. Thanks for joining us.
Thank you.